In recent years, the awareness about China's capital markets has increased drastically outside of China, as both the Chinese stock market and the bond market are making headlines with their extraordinary growth and increasing openness towards foreign investors. Both markets are relatively young compared to their Western counterparts. The first stock exchange was founded in 1891, while China's bond market was created in 1981. While both markets started off with strong capital restrictions and were initially only accessible by domestic investors, they were gradually opened beginning in the early 2000s. In the 2010s, the restrictions on the markets were further lifted, with crucial developments from 2015 onwards, explaining the increasing relevance of these markets for the global financial industry. So let's take a deeper look into both of these markets to understand how they can develop in the future and opportunities they can offer. Let's start with the debt market. The debt market is currently characterized by three main traits. Firstly, it has been growing at an immense rate in recent years, especially since 2015. In the past 4 years, it has almost doubled in size to nearly $13 trillion, becoming the second largest bond market. Secondly, due to the historically high capital restrictions, the share of foreign investors in the Chinese debt market is only 2%. However, China is looking to secure its financial stability, establish the RMB as a major reserve currency, and improve its cross-border capital flows, for which a well-functioning and accessible bond market is an important prerequisite. Thus, China has been opening up its debt market increasingly since 2015, immediately reflected in the increase of capital flows into the Chinese bond market. Thirdly, the Chinese debt market is made up of more than 65% of public debt. Additionally, many corporate bonds are backed by implicit guarantee, meaning they are secured by the government and thus not attributable to classic corporate bonds either. This has two effects. Firstly, options to invest in purely corporate debt are scarce, limiting the diversification opportunities within the market. Secondly, as there's never been a default in the Chinese bond market and the implicit guarantee obscuring any potential default risk, US spreads provide investors little information on the actual risk of the bond. However, since the first Chinese corporate bond default in 2014, with other companies following, the situation is gradually changing. The equity market, however, whilst containing similarities in size, governmental oversight and high return potential, has been subject to early maturation and opening policies as a way to combat the aforementioned indebtedness. The mainland Chinese equity market is made up of two exchanges, the Shanghai Stock Exchange and the Shenzhen Stock Exchange, the fourth and eighth largest stock exchanges in the world respectively, with market caps of $5 trillion and $3.7 trillion. Whilst both stock exchanges have historically been closed off to the majority of foreign investors, initiatives by the government are progressively being made to loosen the constraints, exemplified by the Shanghai Hong Kong Connect program. The Hang Seng stock and derivatives market has been considered an extension of the Chinese stock market due to their proximity and increased integration. The Connect program provides accessibility for foreign investors to buy Chinese stocks, as well as adding an incentive for Chinese individuals to invest, as beta risk makes the stocks on average 25% cheaper. Beta risk, being a typical trait of the Chinese stock market, is the risk associated with the exposure of the stocks to general market movements. The nature of it can be seen in the case example of the 2015-2016 price swings in the Chinese stock market. Within a month of the event, Chinese Class A shares lost roughly a third of their value. The Shanghai Composite Index was down 30%, during which discussions were made about the possible triggering of another financial crisis. This illustrates implicit characteristics of the Chinese stock market, dubbed the Chinese casino. The market is thinly traded with only 7% of the population being invested, of which 80% of said participants in the market are individual investors. Therefore, a few wealthy investors hold 80% of the tradable shares, subjecting the overall market to fad movements. The intrinsic volatility has two main effects. One being the underweighting of the Chinese stocks in portfolios of more institutional investors, and two, the secondary market price discounts that all Chinese stocks tend to have due to the factoring of the risks. So, what does this mean for the future of Chinese capital markets? The size of the Chinese capital market is expected to grow even further, as China requires funding for its investments, both corporate and public. While its development is still largely driven by domestic investors, mainly Chinese banks, international investors are becoming increasingly important for China as a source of financing. Thus, the opening of China's capital markets and inclusion into global markets will be a key driver of their growth. This can be seen in the recent partial inclusion of Chinese bonds in the Bloomberg Barclays Global Aggregate Index, which is expected to attract at least $700 billion to $800 billion of foreign and capital inflows in the next 5 years. Similarly, after increasing the weighting of China's Class A shares in the MSCI Emerging Market Index, foreign capital inflows have risen by $100 billion. For China, however, this also means that it now has to increasingly consider the demands of international investors in the policies that they use to attract them, as they are facing serious trade-offs regarding Chinese securities. Some of the main advantages are China's securities are solely providing comparatively higher returns, and based on China's fundamentals, including its counter-cyclical easing, the attractive yields are expected to continue in the future. Also, due to their low correlation to global securities, they are also an attractive diversification instrument. However, Chinese capital markets are still associated with a variety of idiosyncratic risks, namely the lack of derivative instruments preventing efficient hedging strategies, the restrictions on capital outflows impeding investors from withdrawing their capital from China when desired, the unpredictability of the yuan's exchange rate, and the liquidity problems in the secondary market, explicitly the lack of liquidity in the bond market and excessive liquidity or volatility in the stock market. In order to increase foreign demand for Chinese securities, China desperately needs to address these